We're all familiar with the Benjamin Franklin quote, "The only thing that's certain in life is death and taxes." Taxes are one of those necessary things that nobody really wants to pay. And frankly, they're not even that interesting to learn about. But John, you and I both know that clients really need to have a good understanding of how taxes impact their financial life plan.
Mhm.
So let's talk a little bit about some of those common scenarios that we know clients are facing with taxes.
Sure. Well, I'd say the most common tax is income tax. I think everybody understands that on some level. We get paid from our employer. We pay income tax. We file our tax return in April. We get paid from our business that we own that's also taxed at income tax rates. Currently in 2024, tax rates for income range from 10% up to 37%. Now, there's a couple of other areas, especially in investments, where we pay income tax rates. And that would be when we take withdrawals from our traditional IRAs and our traditional 401ks.
Yeah, that makes sense. What about capital gains taxes? Another common one we see.
Capital gains tax is a little more complex. Not really. Let me help you understand it by tying it to time.
Mm-hmm.
Because depending on how long we hold an investment, depends on what tax rate we'll pay. First of all, what is a capital gain? It's a profit. When we sell our house for more than we paid for it, we make a profit. We realize a capital gain. We're going to have to pay some kind of tax on that. So let's say that you hold some stock or mutual funds, but you hold them for less than a year, and then you sell them at a profit. Well, if you do that, you're going to pay regular income taxes on those profits. So there is a benefit to holding investments longer than 1 year, because in 2024, those capital gains tax rates range from 0, which we would all love to experience, up to only 20%. Remember, the highest income tax rate is 37%.
Right.
So if we sell shares of stock or a mutual fund that we've held for longer than a year, then we're going to pay anywhere from 0 to 20%, depending on our income in that particular year.
Yeah, and just that conversation kind of alludes to some of the different decisions that we help folks make based on income and capital gains taxes and how to take most advantage of their current tax scenario. But that's my bigger question. I think everybody's biggest question. What are some things we can do to kind of control our tax situation?
Well, there's an interesting one in the category of charitable giving.
Mm-hmm.
Most people I see, they're doing their charitable donations out of their checking account. But if they have a brokerage account with highly appreciated securities, for example, you purchased Apple at $5 a share and now it's worth $500 a share. If you sold that, you'd pay capital gains tax, but you could also give shares of stock or mutual funds directly to an organization. So what that does is two things. It accomplishes the charitable giving that you want to do anyway, but you avoid paying the capital gains tax on those highly appreciated shares.
Yeah. Great suggestion. And you and I both know there's lots of different strategies that we can use. Sometimes using Roth retirement accounts, it helps with the tax planning. Business owners have some interesting maneuvering they can do with income. I think the point is that we know there's a lot of depth we can go into with how to be strategic with your taxes in your plan. And that's the encouragement we'll share with our viewers. If this has given you some ideas of going deeper into what you're paying in taxes and what your tax obligation is, this would be a great conversation to have with your McKinley Carter advisor, perhaps a CPA, perhaps a joint team conversation to dive deeper and help you be successful with your tax situation.